Welcome to Wall Street versus Main Street, a different take on the investment show with our host, Dax White. Dax White is the managing partner of the White Law Group, a national securities fraud, securities arbitration, and investor protection law firm with offices in Chicago, Illinois, and Vero Beach, Florida. The White Law Group has represented hundreds of investors in FINRA arbitration claims against their brokerage firms, and throughout this show, Mr. White will shine a light on some of the tricks of the brokerage industry, while also providing valuable information for investors on how to successfully navigate the investor-financial advisor relationship.
Welcome, everyone. You're listening to Wall Street v. Main Street, and I am your host, Dax White. As the lead-in indicated, this is a different take on the investment show. Our objective is not to provide financial advice. I'm not a licensed investment professional, but rather I'm a securities attorney who represents investors in claims against brokerage firms. And the objective of the show is to pass along some of the information that I've picked up through my practice that I wish more investors knew so that they could avoid having to be in situations where they needed someone like me. So each week we'll tackle a different topic where I'll try to pass along some tips, questions to ask your financial advisor, suggestions to make sure that you're having a productive relationship with your financial advisor, because it is unquestionably an important relationship. You know, you're putting an enormous amount of trust in someone as they manage your life savings, either so that you can eventually retire, or maybe you're already retired, but you're putting an enormous amount of trust in that person to make sure that they look out for you. And I don't feel like a lot of people understand that dynamic, what their real obligations are to you, and what sometimes their motivation may be, either personally or, you know, because of what their company's directives might be in terms of the investments that are suggested to you. The biggest disconnect that I see with clients is the expectation, almost universally, that this person is a fiduciary to you, not unlike an attorney would be, where they have to look out for your best interest. And most financial advisors, and certainly most of their lawyers, would argue that that's not the standard, that they do not have a fiduciary duty to you, and that their obligation is simply to make suitable recommendations. And where that difference can be, and it's significant, is that you might be asking for a particular type of investment, and your objective might be X, Y, Z. You know, let's say you want income for retirement. A fiduciary would be required to pick the best investment for you based on all of those considerations, making sure to keep the commissions down, making sure to select the investment that's best for you. And an advisor who's simply making a suitable recommendation could look at maybe 10 investments that all basically meet the criterion, and they could pick the one that pays the highest commissions because that is, they could argue, still suitable for you. So that is where the biggest, to me, fundamental disconnect is. But that's the objective of the show, is let's pass along that type of information so that you sort of have that in the back of your mind when you're having meetings with your financial advisor, so that you can be sure to ask really informed, hard questions to make sure you're getting the answers you want and the advice that you need. So this week we're going to tackle a specific product that we've seen in litigation a number of times over the last few years, and it's all sort of fallout from the real estate market collapse. But the investment is called a tenant in common investment, also commonly referred to as a TIC. And what a TIC is, by definition, is that you have co-owners of an undivided interest in real property, and the tenant in common each own a separate and undivided interest in the same real property, and each has an equal right to the possession and use of the property. What does that mean? That's a very convoluted way of saying that you're essentially buying a fractional interest in a real estate venture. And typically what is happening here is that you're buying into a larger real estate deal than you would be able to afford on your own. You know, what we see in the context of our practice is people who, they managed a personal property for, you know, investment property for 40 years. They rented it out to tenants. Now they're reaching a retirement age. They're relying on the income from that property, but they don't want to manage it anymore. And somebody suggests to them a TIC. And in a TIC, you can sell the investment property, and as long as you invest in a like-kind exchange, 1031 exchange, within, I think it's 180 days, but a very specific time period. As long as you invest in another piece of property within that time period, you can defer the taxable gains on your investment property, buy into this larger, it's often strip malls, apartment complexes, commercial, office buildings, things where you're going, wow, this is great. I'm getting, Class A property. There's a manager. I don't have to deal with the tenants anymore. I just get my income. Again, this is sort of how it's packaged, but that's typically what we see is that you're buying like a 2% interest in a mall. You sell your investment property for $500,000 and you buy, 2% in this huge $20-30 million deal. And most people at least would never be able to be in a position to do that on their own. So they view it as a very good thing. Here I am buying into this huge property with all these great tenants, and there's a manager, and they make sure I get paid, and all of these considerations. So that is basically what a TIC is. But there are some limitations. There's pros and there's cons. So what do we see in our practice, and what can be some of the potential drawbacks and pitfalls? Again, the hook, as I mentioned, is that it's often sold as a way to defer taxes, because let's say you had a piece of property, if you owned it for 40 years. I mean, we see this all the time. You've got, teachers in California, and they're in their 60s, and they've owned this investment property for 30 years, and they paid $80,000 for it, but now it's worth $2 million. And so they're going to have this huge taxable gain if they just sell their property and don't buy something else. So, somebody comes in and the hook is, hey, we're going to be able to defer the taxes. You don't have to pay those now. And you're going to get to go into these, Class A properties. You don't have to manage it anymore. Usually, some of the sponsors will even guarantee income. But most of them will say, this is the projected income. So that's the hook. And potentially the pros. Certainly, buying into Class A properties can certainly be a good thing. But the cons are that the investments, are exposed just like anything else to the real estate market. They're usually highly leveraged, so that creates enormous risk, because if you own a mall and the market, you lose a couple of big tenants, and the market tanks, and suddenly, all the equity that you guys all put in is gone. And the worst case scenario that we see is a lot of these properties are in foreclosure. Don't think that a mall can't go into foreclosure, or an office building or an apartment complex or anything else. And so the investments inherently come with a great deal of risk. And unlike a property that you would own individually, you are beholden to the group. Because you own an undivided interest in a specific part of the property, generally speaking, these agreements are drafted that you can't sell unless everyone's on board. You can't get rid of the management company unless everyone's on board. It's very difficult to make changes. So if you see a property that is not doing well, you sort of have given away a lot of your rights to make sure that you have control over improving that property, because now you're relying on the other investors. And for that reason, they are generally considered illiquid. You might have a situation where, okay, I invested my $500,000. I wanted income. But now, I just had a heart attack and my insurance isn't covering it, and I've got all these medical bills piling up, and I need access to my money. That is not possible with TICs. Again, unless all the investors are on board selling, and in many of these TICs, you see 30, 40 investors, unless they're all on board and they're all going to have their own things going on in their lives. So they're probably not, because of your situation, going to be okay with just selling the property. You're stuck. And so you've eliminated your access to your own money. So that's certainly a limitation. And then the biggest of them is and it seems like we talk about this every week, but it is true that generally speaking, a lot of our cases, have to do with high commissions and greed. But these are one of the highest commission products out there, often paying as high as 7 to 10%. For example, an ETF pays 0.1%. A mutual fund, 1 to 2%, an annuity, 4%. An annuity is considered, or at least a variable annuity is considered a very high commission product. So a TIC is like on a whole nother, arena. It's almost double some of those products. So it's an extremely high commission product. And what's interesting, and FINRA has stepped in with some regulations, and certainly we employ this when we're litigating these types of cases, is, the brokerage firm would argue, yes, but we're saving all these taxes. I would counter that by saying, no, you're deferring taxes. Eventually you always got to pay Uncle Sam. But more importantly, the cost of these investments can almost neutralize the tax savings. Depending on what your income might be, your tax bracket might be 25%. But when you factor in all the costs of these investments, you got 7 to 10% to the financial advisor. You usually have marketing fees for the sponsor, due diligence fees for the sponsors. It might get to 15, 20% expenses, which almost neutralizes the tax advantage. At a certain point, you'd be better off just taking the tax hit and getting into a better investment. So to me, that's one of the cons is that you have an enormous expense situation where the people who profit on these investments, at least in my humble opinion, are the sponsors. They're the ones that put together the deals. Everybody gets paid. Financial advisor gets paid. Sponsor gets paid. The management company gets paid. And if the market is upward moving, it can work for the investor unquestionably because these investments have worked. But if the market moves against you, like it did in 2008, what we've seen at least is that the equity gets blown out, property goes into foreclosure, the investor loses their income stream, they lose the property, and they're out. And that tax deferral doesn't seem like such a great advantage anymore because guess what? If you lose the money, you don't have to pay taxes. For a lot of investors, that was the hook is, oh, great, I don't have to manage the property anymore. I'm going to get this tax deferral, keep getting income. But that's the rosy picture that's in the glossy, packet they give you. The real picture is high commissions, illiquid, high risk, and a lot of these deals went bad. But that's sort of the common story we've seen is again that you've got financial advisors who focus on income stream, and again there were sponsors, DBSI being one that comes to mind, that guaranteed the income. Now, granted, the guarantee was only based on the company's ability to pay it, but that goes a long way when you're trying to sell an investment to an investor. Typically, that guarantee was 7%. So if you're owning a piece of property and you sell for $500,000, you need $35,000 to live on. And DBSI or a financial advisor who's selling you DBSI says, "Hey, I've got this investment. It will guarantee you get your $35,000 per year." That sounds pretty great. Problem is DBSI in November of 2008 declared bankruptcy and nobody got their guaranteed money. Turns out that what they were doing towards the market collapse prior to the bankruptcy is they had properties that were performing, properties that weren't performing, and they were commingling the funds between them to make sure everybody still got their guaranteed so that they could continue to sell them and make it seem like everything was going great, when in reality, some were working, some weren't. But, they had to pay out their guarantee, and right up until the point where they didn't. So, that is the worst case scenario, obviously, but we saw it over and over and over again. So if it's being suggested to you, hey, here's this opportunity to defer taxes and get an income stream and buy any of these great properties, that may all work. But there's certainly some pitfalls and there's a lot of risk there, and there's a lot of questions should be asked if you're being recommended a tenant in common or TIC. The sponsors that we saw the most, as we litigated a number of these cases, DBSI I mentioned, that was probably the biggest one. They were a huge Idaho-based company. They sold hundreds of millions of dollars of TIC properties, and it worked. It worked for a long time, but it sort of worked in spite of itself. You've got these huge commissions. Anytime again on our website, Wall Street v. Main Street, there's a report it's an article that discusses how commissions can impact performance. But if you're taking 7 to 10% off the top, it is very difficult to beat the market. It's difficult to track the market. But if the real estate market's going up 15% per year, you can you can still pay out your 7%. You can still pay the commissions to your financial advisors and do all of these things without it negatively impacting the investors to a point where they go, "Oh my God, what happened?" But that doesn't mean that it was necessarily performing optimally. When you have got those huge commissions, you're still impacting performance. And now you've got to, through risk, you've got to outperform the market by 7 to 10% in order to get back to even. And so again, it worked for a while, but that's during a period where the real estate market was booming. But as soon as the real estate market turned against these types of investments and corrected in 2008, a lot of them got blown out, because if you've got only 20%, if you took out a mortgage for 80%, and the investors put in 20% equity, but of that 20%, you paid out a ton of commissions to a various number of people. Let's say it's 15%. So really, you only had like 17% equity in it. The market moves against you by 17%. You got no equity. And a lot of them limped along because they still had cash flow. They still had tenants that were paying the mortgage. And so maybe they were underwater, but the bank didn't move to foreclose. But as the real estate market, or just the market in general, continued to limp along, and you started losing tenants, if you're a mall and you lose your J.C. Penney, and now your cash flow is not enough to pay the mortgage, you either have substantial capital calls to the investors, or you stop paying the mortgage and you get foreclosed on. And again, that's your worst case scenario, but we saw it. But again, DBSI, again, we saw tons of those. Other examples: Wells Management Company, Triple Net, Pasco, Covington, Mission, Cabot. If you've been hearing some of those names recently, you might be a financial advisor might be suggesting that you buy a TIC. If it's a 1031, if the discussion is a 1031 exchange in order to do tax deferral, and that's a big difference from tax avoidance. Make sure that is understood. It's tax deferral. You still got to pay it. You just don't have to pay it now. But if that's the discussion with your financial advisor, they might be suggesting a TIC to you. So just keep those things in mind, because it's not this rosy. They can work, but it's not this rosy. You get income and you don't have to manage the property. They do it for you, and it's not risky, and you'll just get your income for life. It unfortunately is not often that. Questions that you should be asking, sort of, again, what is your commission? And if they can't justify their commission, and again, there is a FINRA notice to member on this, which says that their recommendation has to factor in the tax consequences, and whether or not the tax consequences, the tax savings or deferral, outweighs the commission. They've got to make sure they can justify that recommendation. So ask them what their commissions are, and then just ask them what some of the other options are. I mean, in all of these cases that we've had where people have suffered losses and TICs, I've told investors the same thing, and invariably the financial advisor unfortunately never did this. But if the financial advisor had said to our clients, okay, option one, we'll do a 1031 exchange, we'll go roll it into this property, here's the features, here's my commission, here's the risk, or we can take the tax hit and you'll have less of a net, but we can take that money and we can invest it in either a basket of mutual funds, or we can do a bond portfolio. We can accomplish all these other goals. If after giving you those options and explaining the risk and explaining the pros and cons of each, you had decided, no, I don't like paying taxes, I want to do a TIC, then it's on you. I mean, you're an adult and you're entitled to make investment decisions. But unfortunately, in our experience, a lot of the firms that sold these products, this is what they sold. And so if they don't sell you a TIC, they're not selling you anything. So they're not suggesting to you that you take the tax consequence, take your business somewhere else, and invest in these other portfolios. Usually they're selling you on the hook, which is that these are, safe income producing investments. But ultimately that's unfortunately not what they are. So, but ask them, what are my other options? And if they say, no, this is it, that's a red flag. Overall, my opinion on these particular products is that the costs generally do outweigh the tax advantages. There's certainly a value to you personally not having to manage the property. But if real estate is where you want to be, there are cheaper ways to get into real estate, other ways to accomplish that. There's certainly real estate mutual funds that you can buy. There's publicly traded REITs that you can buy, that invest in larger properties. So there's lots of ways to get into commercial real estate. There's lots of ways to do it that are more liquid, less risky, less costly. So, that's my overall suggestion would be, see what your other options might be. We're going to take a commercial break and then come back and wrap things up.
It's time to call Easy Brew Coffee and Bottled Water Service and learn just how much you can save and how convenient it is to have your coffee and bottled water delivered right to your home or office. In addition to water coolers, Easy Brew offers individual bottles of water in 8 or 16-ounce bottles. No more lugging it home or dragging it into the office. Serving the Treasure Coast for over 2 decades, 2 letters, 1 simple name. Easy for Easy Brew. Visit e-zbrew.com or call 800-792-3285. Easy Brew.
You can trust Sandpiper Pest Control, serving Indian River, St. Lucie, and Brevard. Certified by the state of Florida to treat homes, lawns, and termites. Fully licensed and insured. Priced right, effective, and friendly.
Hi, this is Joel, the owner of Sandpiper Pest Control. Sandpiper can solve your pest issues. No contracts to sign, just results.
Call for a free estimate, 772-589-0204. Sandpiper Pest Control, a member of the iTex trading community. Your iTex dollars are welcome.
Blue Dolphin Pools strives to provide quality service with a well-trained staff in the field and in the office. They want you to know that your pool or spa investment means much more to them than just another account. They believe you have entrusted them with your investment, and they'll do their best to see that it stays in top condition. Blue Dolphin Pool has been in business over 35 years, setting them apart from the competition. Residential or commercial, Blue Dolphin will keep you in the swim. 567-5853.
Welcome back, everyone. You're listening to Wall Street versus Main Street. I'm your host, Dax White. Before the break, we spent a little bit of time talking about tenant in common or TIC investments, the pros, the cons, certainly some of the drawbacks and some of the war stories of what we've seen as we've litigated these types of cases over the last 8 years now. As I mentioned before the break, my basic takeaway is if real estate's really what you want to be doing, that there are other ways to accomplish it. Again, it's tax deferral, not tax savings. So at some point you got to pay the government. But it should be mentioned also that sometimes these deals are not real estate deals. You can do a 1031 exchange into other products. There's some oil and gas ones that are out there. There are other things that would qualify for that tax deferral. So it's not always going to be real estate to real estate. It might be oil and gas to oil and gas, or even I think you can even do real estate to oil and gas. So there are some other investments out there that would sort of fall into that same category. So I don't want to make it seem like it's just real estate, but overall, that is a product that you will often hear if you are selling an investment property you've owned for a really long time and you've got a big taxable gain that you've got to factor in. You might be offered a TIC, and I want people to understand that there are certainly some drawbacks to that product. Tune in next week where we'll be tackling additional topics that I think are relevant to investors in their relationship with financial advisors. For more information either on what we touched on today or on previous episodes, check us out at wallstreetvmainstreet.com. You also can find our info on Twitter, Facebook. You can find our law firm at whitesecuritislaw.com. I think these episodes are even broadcast on live stream and YouTube, and we're all over. Check us out and tune in next week again, where we'll hopefully pass along some more information to make that relationship more productive with your financial advisor and to shine a light on some of the tricks they use to sell you products. Thanks.
You've been listening to Wall Street versus Main Street. The views expressed by the participants of the program are their own and do not represent the views of, nor are they endorsed by, the White Law Group, its officers, directors, employees, agents, representatives, shareholders, nor any of its subsidiaries. None of the content should be considered legal advice. As always, consult a lawyer.